Great, thanks Tom, and thanks everyone for joining us today. I'd like to pick up a bit sort of where Tom left off, and when we're looking at the first quarter returns in equities, sounds excellent, and in fact they are. I mean, these are stellar returns that we've seen for the quarter. And I'm also reminded of what we've seen in the last couple of years. In 2010 and 2011, we also saw equity markets jump ahead and have an excellent quarter, only to get a little soft, and then by the time summer rolls around, everyone's starting to feel very sour again, and we seem to be in this rut where we get off to this a great first quarter and then see the rest of the year kind of limp to the end. Although fourth quarter was a pretty good one for equities as well. For the first quarter for fixed income funds, it's actually a decent quarter. Although we saw some softness in March, overall things were pretty good. So the first slide we're going to look at is the yield curve. The gray one is from the end of 2010. The orange one at the very bottom is end of 2011. And the red one in the middle is end of first quarter. And as you can see, we saw the yield curve steepen a bit and near the long end of the yield curve. Not a whole lot of change though at the short end, and of course both 2012 2011 points here are very low. We are still in a very accommodative, very low rate environment, so even though the yield curve did steepen a bit, it was not catastrophic by any means. We don't have a return to 1997 or anything like that, or I'm sorry, 1994. So overall, it was a decent quarter for fixed income. We'll go into more detail in a few minutes. I'd like to turn also to what happened with Treasuries. As you can see, most of the activity was at the 30-year and the 10-year. We saw rates rise on the 10-year from just below 2% to just about 2.25%. Although they're down from their March high. Mid-March is when things started to kind of turn south a little bit for equities and up for fixed income. But overall, it was kind of one of those consolidating quarters where we saw people starting to wonder if perhaps the global economy, if certainly not the U.S., was starting to find its feet again. Certainly when equity markets take off the way that they did in the first quarter, it's hard for a fixed income rally to also take hold. Most of the good performance that we saw for fixed income occurred in January. This was a time where we saw 2 and 3% returns for a lot of categories, such as intermediate investment grade and certainly for high yield. And then February, March, things start to soften a bit. So I'll go through the next slide here, and I won't go through every single one, but this is kind of setting the table for what happened in the quarter. So we'll start off, let's talk about TIPS first, Treasury Inflation Protected Securities. That group was up 1.21% on the quarter. That's a very good quarter for them. We saw in this time that the U.S. sold about $13 billion of 10-year TIPS at a record low yield of negative 0.089%, so just under 9 basis points of negative yield on 10-year TIPS. So even though they sold in January at a low yield for the first time, at a negative yield for the first time, it got even more negative in March. So there's definitely some burgeoning expectations, some momentum building for inflation to rise. Well, if inflation's heading our way, why are they paying a negative yield? Well, they're going to price lower than Treasuries anyway. With Treasuries still very, very low, they had nowhere else to go but below zero. So it's just a shade under zero. Still, it's one of those moments where you think, wow, that's kind of crazy that anyone would buy Treasuries with a negative yield. This is not unusual for the 5-year TIPS either. They've had a negative yield at their last 4 auctions. So we're starting to see people get probably a little unsettled at where the 5-year auction is going, but they're starting to push that out onto the 10-year now. The break even between the 10-year tip and the 10-year regular Treasury is 2.38%, 238 basis points. That's above the 10-year average of 213 basis points. Again, it's kind of pointing to some building expectations about inflation. We're seeing that 10-year inflation average, at least as it's priced in the market, start to rise a little bit from the low twos, getting toward the mid twos now. So that was behind a lot of the activity in tips, and certainly as the economy expands, as Tom pointed out, we see payrolls do better. A lot of the manufacturing indexes stay in that expansionary territory. That's probably going to fuel a little bit more inflation trades throughout the quarter. The next group we're going to look at, or I'm not going to go down through each of these point by point. No, we'll skip ahead. Intermediate investment grade debt funds, that's the top gray line. They were up 1.5%. This is also our largest taxable fixed income category by a wide margin. I think there's about $770 billion at work here. The average fund in this group only has about 7% in high yield. So even though we look at the Barclays aggregate and we see, well, this is quite a big mortgage play in this index right now, the outperformance here over comparable short and intermediate U.S. government funds up above really wasn't due to the high yield. In fact, it's probably more due to about keeping the maturity low and the duration a little bit tighter in this group versus the index. So about 30% of the average allocation to the 5-year and under maturity in this group is about 30% right now. So they're starting to build up more of their short-term position as a group. So that was probably why they outperformed, because we saw the short terms outdo some of the longer duration products in this quarter. Corporate issuance, here we'll just go off on a tangent here, but corporate issuance in the investment grade market was about $275 billion this quarter, and that's the best one in a long time. The previous record was $272 billion, and that came in the first quarter of 2007. So the investment grade corporate community is trying to refinance as much as they can right now. They want to get a lot of debt out the door. It's a low rate environment. Again, this kind of plays into that inflation expectation that we just talked about. So the other point worth noting is that Q1 2007 was right before the financial crisis, and things started to fall apart pretty quickly after that. So hopefully this is not a harbinger of things to come. The next group we're going to take a look at, high yield funds. They were up 5.42%, one of their best quarters in a while. They saw about $97 billion in issuance in Q1. That's very strong. The best part of the high yield spectrum was in the very low rated, the triple C, the very junkiest of the junk that's not defaulted. That paper was up about 9.2%. So again, in line with the activity in the equity market, the closer you were to equity, the better you looked. Fantastic time to be in high yield right now. We'll go farther down on the chart, loan participation funds. A lot of interest in these guys. Loan volume in 2001, at least in the U.S., was $335 billion. That compared to $394 billion in the same quarter in 2011. So we're starting to see some of these firms unable to get some of this the syndicates together. We're not seeing as much money raised in the loan area. You'd think that with more risk-taking going on, especially in the equity and the high-yield community, that loan issuance should not be a problem. But in fact, I think people are not forgetting what just happened in Greece, and they're still a little skittish in some of these markets. So kind of a dichotomy going on right now in high yield and loan participation. We'll skip on down. Ginnie Mae funds, I'm sorry, U.S. mortgage funds, they were up about 1.18%. We don't often talk about mortgage funds, but certainly with Double Line creating a lot of demand for products in this group, that gets a lot of people's attention back on mortgage funds. They've done very well, certainly under Operation Twist. That's the Fed's program to shorten its maturity, and they're buying a lot of mortgages to do that. That program ends in June of this year, so there's still a little bit of road left, or a little bit of runway left for mortgage funds. We'll see if a QE3 program ever comes to bear. A lot of speculation right now is that it could focus on mortgages, just like Operation Twist, or in something similar to that. That could be very supportive of mortgages going forward. We'll skip on down. General U.S. Treasury funds, worst performer of the quarter. They were down 2.68%. This is a long duration product, and as we saw in the first slide, the yield curve rose at the long end especially, and this was a negative for general U.S. Treasury funds. They also had a pretty poor March, unlike everybody else, where March just kind of limped along. For U.S. Treasury funds, they were down about 1.7% on the month, so they kind of ended with a thud as well. Most everyone else had kind of a soft March, but generally speaking, the Treasury was the worst area to look at. Next group we'll skip down to emerging market debt funds, the quarter's best performer. They were up 6.92%. Emerging market local currency funds have been all the rage lately, notably for their yields. The local currency yield on one of the popular indexes is about 6.3% right now. This compares to the U.S. dollar denominated version, which is yielding 5.5%. So, as we search out yield in this low rate environment, it's no wonder that we see a local currency debt jumping ahead and really driving a lot of the interest in emerging market right now. We'll skip down to international income funds. Here, again, we saw strong issuance globally for corporate debt, although the forecasts right now call for a drop in European corporate issuance in 2012. This might tighten the supply out there. This may be supportive of international income funds as investors want more of debt from all over the world. They're not going to find as much in Europe. As we start to worry not only about the exposure to Greece through various banks, but what happens with Ireland and Portugal, and we'll go into some of those questions a little bit later on. Overall, the Europe, Middle East, Africa, the EMEA issuance in total was fairly strong in Q1. We don't see that trend continuing in Q2. We think things are going to start to tighten up there a little bit on the supply side. And then finally, if we look down, municipal debt funds, high yield muni, clearly the strongest performer this quarter in the municipal debt area. They were up about 4.78%. Munis did kind of follow the path of Treasuries in March, where they tended to sell off a little bit. High yield was immune to that issue. They actually were up about 30 basis points in March. So we're still seeing decent but little softer flows into municipal debt right now. But we think that looking ahead, that I think investors are not going to overlook municipal debt. And they certainly didn't in Q1. It was a good time overall for municipal debt, not necessarily just high yield alone. Overall, we saw municipal markets up about 2.5%. So not a bad quarter for munis. The next area we'll look at is my concerns about the quarter ahead. Tom alluded to some of these. They're kind of front and center in a lot of investors' minds. I don't think that we've heard the last of Greece. We got an agreement between the Troika and private debt holders. There are still some debt holders out there, private debt owners, that have not conceded to this agreement, and that could spell some troubles later on. Portugal and Ireland, as I mentioned earlier, are probably the next version of Greece that's not going to be the same, but certainly Irish citizens are looking at how Greece was able to get their overall debt reduced, and I'm sure that they would look for a similar deal at some point. I have to believe it's this year, if not this summer at some point, that Irish debt looms large again. Spain and Italy, I said loom large here. Well, not quite as soon as Portugal and Ireland, in my estimation, but they still are the 800-pound gorilla that would really set a lot of expectations about a global recovery on its ear if something were to take place along the same lines as Greece in those two nations. And then the economy on the state side. We've seen some decent numbers. We're seeing, ISM index still expansionary, still above 50. You'd think during a recovery that it's going to pop up a little higher. It really never has. A lot of job creation numbers, decent. 120,000 is good. We really need, something close to 300,000 to really sop up a lot of the unemployed out there. And a lot of the long-term unemployed are not turning back, so the U6 measure of unemployment is still very, very high. And I don't see a lot of fiscal reform along the way to address that. So that's just going to be one of those nagging statistics I think we have to talk around for a little while. And with that, I will conclude my presentation and turn it over to Matt Lemieux.